Hello, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown on GameStop. I am your host, Dr. Michael LoPiano. It's very good to see you all once again. Thank you, everyone, as always, for your support. We had a great turnout for last Friday's live stream. Very excellent to see everybody. Very excellent to see questions and whatnot. Very interesting time digging into some of these deeper questions about what happened with GameStop, maybe in some of these earlier upper volatility events, thinking about what might need to happen going into some new upward volatility events, possibly in the circumstances of something like a requel heading into 2025. Very good time. We will continue thinking about that on future live streams. For today, we are turning our attention once again back to our day-to-day grind. What are we looking at this week for this particularly short week? We have a half day tomorrow in the market. We have a closure on Wednesday. So what are we really looking at here? What do we make of this particularly high end of week close? So last Friday's trading ended at $29.92. That's the highest close GameStop has seen in 2.5 years, which is a very encouraging trend to see. So what do we make of this? Is this some indication of breakout bullishness in the future? Does it mean we just go straight up from here this week? Are we, as I've mentioned in the title, both of this video and of this week's, today's analytical article, is GameStop leaving the 20s behind? So that's what we're going to think about today. As always, if you are watching this video on YouTube, you can find the link to my daily analytical article. I write up digests, analyses of the options data and technical data on GameStop every single trading day. You can find that on my X page pinned at the top. It is linked down in the description on YouTube. It is, of course, up at the top of the page if you're watching this video on X. So let's hop in and take a look at today's breakdown. So leaving the 20s behind, right? We are looking at not only are we coming off of some particular bullishness, perhaps some otherwise unexpected bullishness heading into the end of the week, but some GameStop bullishness amid broader market instability. For those of you perhaps that take a look regularly at spot gammas, broader market breakdowns with respect to options data, we crossed a major threshold last week. I talked about in those videos with respect to trading down in the market on Wednesday, right after the Federal Reserve. The broader market, SPY, SPX, NASDAQ crossed critical support levels and fell. I think SPY came and mentioned that SPY fell the greatest absolute value of reduction in basis points, something like that in, I don't know, in the past 5 years. Of course, this makes sense, right? When you trade at all-time highs, your percentage drops tend to be pretty large in terms of absolute value. But nonetheless, right, the market is in this state of upper volatility. The 6,000 SPX level support has now moved over to 6,000 overhead resistance. So some question marks there, but with GameStop, something that's looking like the inverse, right? We're seeing a close. That's the highest we've seen in years, right? In over 2 years at this point. So on this, right, the 111th birthday of the Federal Reserve, let's take a look at maybe what are some of the factors that are driving this. So last Friday was particularly interesting because we got our test, like I talked about, right? We got this test of the lower bound of our principal technical paradigms here. So we've been looking at this sub-regression channel within a broader regression channel. So two nested regression channels. The broader macro regression channel is this bull trend that's been developing for about the past 6 weeks, maybe going on 7 now, dating back to the last couple trading days of October, beginning with the VW squeeze anniversary on October 28th and the National Cat Day Catalyst, the day that Roaring Kitty, otherwise known as Keith Gill, filed a 13G announcing his complete departure from his position in Chewy. So this began a bull trend, which has been continuing to unfold since that date. It has not abated. Um, Despite some efforts by bulls in the first couple weeks of December, right, following Thanksgiving, the last time we had a particularly short week, that attempted to eject our price from these principal paradigms on our 4-hour chart. So yesterday we got a test of the lower bounds of what had been a bearish regression subchannel that has become something more range bound within the context of this continued bullish channel. We got a test of this support in the pre-market, which I talked about on Friday's video and discussed in the analytical article for Friday as well. We got a test of this level, traded up, briefly came back to the confluence of sort of VWAP. We traded between VWAP and the 200-minute simple moving average here, before then just going straight diagonally up. So the price then rode, this is very unconventional, right? We do not often see just the price trading straight up and riding the 20-minute moving average. That doesn't occur very often. When I see something like that, that looks to me like a VWAP order. So that looks like, for example, okay, so sometimes when someone's margin called, they have to punch through a VWAP order. If somebody has excessive fail to delivers on reg show, what is it? The threshold securities list, VWAP orders can get pushed through. If there is a large amount of settlement, if there are particularly big orders coming through, what brokers will do is punch these orders through they'll enter them as the volume weighted average price. So buying this very large order will start, continue throughout the day, and this is what this tends to look like. It looks like this kind of pretty tight, shaded, not really oscillating very much, diagonal line to the right. It'll look something like that. That's a VWAP buy order. So this continued up until we tested the upper bound of our range bound sub regression channel, formerly a bearish channel, now more sideways and kind of tilting actually bullish. It's more or less aligning, as we'll see in a bit, with the lower channel, the lower half of our macro bullish regression channel. Deflected off of this, and then we traded down into the close for yet another close below $30, as I pointed out at the beginning of the week. Right, beginning of the week. Right, look, this isn't magic on my part. This is just a regular insistence on this hypothesis, right? This sort of position that I've held for some time. This proposition, I should say, that the equities market, certainly GameStop, is in what I have referred to as a state of derivative capture. The stock itself, the underlying stock, is being held captive in order to feed the profitability of the options market. The options market exercises, as I've talked many times before, a tremendous influence on the day-to-day price action of the stock through market maker hedging. As traders buy and sell options, they influence the hedging behavior of the designated market makers, I should say, right? The designated market makers who have a responsibility to provide liquidity, no matter what, based in reason on a bid-ask spread in the options market, to facilitate the actual exercise of an options market, right? So, for example, you might think that when you go out to the options market, you put in an order, your order is getting paired to some other buyer somewhere else in the world, and retail traders are just all trading with each other. That is, by and large, not what happens. What seems to be the case, and what the role of the designated market maker is to essentially put out some bids, right? Put out bids, put out asks, say, supply liquidity, supply quotes to all of these different strikes using a dynamic pricing model, most commonly a modified version of the Black-Scholes model. And when you go and buy or when you go and sell an options contract, you are selling it to a designated market maker. You are not selling it, or you are not buying it from another retail participant. The designated market maker acts as a middleman between many different retail buyers by adjusting the quotes of these prices. So it's not really, in most cases, it's not individual traders, individual investors putting out bids, but rather this designated market maker who is dynamically offering quotes. So it's really one buyer, one seller, and then all of retail, all of traders come and then purchase these contracts, which are written and dealt by a designated market maker. In the case of GameStop, that designated market maker is currently Wolverine Trading. So that's really right. That's really where those trades are coming from, and with some perhaps surprise, some perhaps not. Right, on a regular basis, we frequently see in excess of 90% of the total options open interest for GameStop expire out of the money. This means that dealers who are primarily short, right, retail traders tend to be long. They tend to treat options contracts like they are shares and tend to use them as instruments which are structured probabilistically against their favor, right? Calls, puts, long calls and long puts are structured to favor whoever the writing party is. So once again, right, beginning of the week, this has been something that's factored into my trading strategy for many months now, is the understanding that, sure enough, GameStop will close below major points of dealer options gamma exposure, right? So usually the most consistent level of hedging that they undergo is based around hedging for gamma, which is the rate of change of delta in their options contracts. And by doing this, if you can track the gamma exposure of particular, with respect to a stock, you can see where key, let's say, key concentrations of gamma exposure lie. And you can anticipate how market makers will nudge the price, right? They don't have perfect control over the price. It's not that they're going and, say, setting the price at any given point, right? It's not manipulation that works like that, but they can nudge the price such that it just so happens to end at a level that is shockingly close to where their theoretical maximum profitability point would be. So that is not quite, right? Interestingly, that's not quite where we ended up on Friday. In Friday's video and in Friday's article, I spoke about what I assumed was a true max pain point, a true optimum profitability point being somewhere around $28, maybe slightly below $28. And I was expecting some intraday tests, maybe to have even gone up as high as we did. But what was interesting to me is the price stayed buoyant, relatively buoyant above our $30 call wall into the close. And market makers, that is, those who are nudging the price into the end of the day, only just barely got that $30 strike to close out of the money. Our closing price at $29.92, as I mentioned in my introduction. That's the highest that GameStop's closed in 2.5 years at the end of a week, right? For a weekly close. We've had midweek closes, we've had daily closes that were higher. But yes, even going back to May and June, where we saw valuations in the price, we saw price values at $40, $50, $65, $80 in the pre-market, even with prices this high. In none of those weeks did GameStop's closing price end above $30. Did not happen even amid all of that upward volatility. Those wild swings in the prices still closed below $30. It turns out that this week's close, this past Friday's close, was higher than any of the weeks during our May and June volatility. Shockingly, I know, shockingly, by several dollars even. So this was very interesting to see. We also had a substantial amount of volume show up on the tape on close. And curiously, within about the last 20 minutes of trading, we had excessively large dark pool orders show up. I mean, the star of the show obviously is this one for 1.12 million shares, an order almost $34 million in price, but others as well, right? Many blocks of well over 100,000 shares. Normally in trading GameStop, an order showing up in the dark pool that's over $100,000 is rare, right? That's something to remark about, right? Remark upon, to see, yeah, an order of something like 100 or 150,000 shares. And here we just see block after block of 157,000, 138,000, 106,000, even ones that, you know, are decently sized here, where you don't see that many, right? 36,000, 16,000, 25, 40, 20, 10, 20, right? Clusters of tens of thousands of shares. You know, we had at least 10 blocks of over 100,000 shares. And then we got these 3 blocks just before the over 1 million share order of 384,000. Interestingly, 2 identical blocks of 384,820 shares, and one of similar size at 329,848 shares. So well over, it looks to be certainly well over 50 million, probably pushing, I'd say probably around $75 million in dark pool volume on close yesterday, between close and about 4:20 p.m. Eastern time. Maybe you can push it to 5:30. Rare, not something you see very often. Now, it was triple witching on Friday, and we did just come off that Federal Reserve dump, right? That event that broke this critical support, this critical 6,000 level in SPX, this 600 level in SPY, and triggered volatility, caused the VIX to spike. It's possible that this was a bit of a recovery based on replenishing something like ETF flows. It could have been related to rebalancing, something like this. Possibly it did have something to do with insiders buying, which we speculated on last week a bit. It's hard to say. It's hard to say. I'm not sure. I'm not going to speculate on it too much, but it is safe to say that there was a significant amount of volume. I wonder, upon watching this and seeing this buying pattern, this VWAP, what looks to me like a very large, a series of VWAP orders kind of just being executed back to back to back to back to back. I wonder how much of that volume was actually filled during the day and these orders were bumped to the after hours. You notice it's not like we got very much after hours movement. Where necessarily were the counterparties for these orders? From whom were these shares purchased? Were these all purchased intraday? How much volume is this? It's several million in volume. It's not, I guess it's not absurd to believe that this 3 or 4 million in volume was covered early in the day for those first 4 hours of the day. It's very possible. It's very possible that all of that was bought and settled and covered, and sort of just the order was listed as something that was listed as on close, something like that. Hard to say. We could continue to see some of this continue into this week. Maybe some of this did not particularly, maybe not all of this was settled, and there needs to be more settled, right? Max Payne was down around $28. Maybe there was some hedging that wasn't completed. There are some shares that need to be purchased and delivered intraday, right? I don't want to speculate on it too much, but it is interesting to see, say, how after hours price spiked all the way to back to 30.25, and of course pre-market we've been above $30. Yeah, technically we are right looking soundly, as you can see, right? We're soundly here in the midst of our 2 regression channels, our macro bullish channel. Our price is hanging out, right above all of our moving averages, which they're arrayed in this bullish kind of fanning pattern, right? You want to see them stacked all on top of one another. So the 20, the 50, the 100, and the 200, that looks about as good as it can get. Obviously, you want to see them, right, a real bullish breakout. They're going to kind of start to fan out, basically like we saw back here. This was our, super bullish period, and then we had some confusion because they started to cross a bit. Where are we going? Are we breaking out of this? And now they're starting to widen out again. We really scrupulously stayed within our sub channel. And as I mentioned a little bit earlier, this range bound channel is transforming into a flatter, a lower incline bullish channel that, right, it's sort of more or less mapping with the lower half of our macro bullish regression channel. So what that suggests is the continued validity of this combined paradigm. It looks like, yeah, we're going to continue trading within this. We've had several failed attempts to eject us from that macro bull channel. We touched the confluence of the sub channel and the larger bullish channel here, right, bounced right off of that and up to almost made it to the midline, not quite. RSI is right around 55, so still neutral on our 4-hour chart. And it's, yeah, just looking at this, right, we could break up, we could break down. I mean, our adherence to the lower channel does suggest that there's, I mean, certainly a possibility to break down earlier in the week on this short week. However, certainly as we take a look, right, at some of our longer time frames, say we take a look at our weekly chart, this is particularly bullish, right? We haven't seen closes 4 consecutive weeks close above the 200-week moving average. We have not seen something like that since the 2020-2021 run-up, right? So we actually saw 7 consecutive weeks of trading above the 200-week moving average before things started to go exponential at the time that Ryan Cohen announced his intent to join the GameStop board. So, yeah, so I mean, requel-wise, rhyming-wise, we're right about here on this timeline, right? So we're actually, yeah, this weekend, the 5th week, the week of Christmas ended up being particularly bullish, right? The stock price shot from just under probably about 375. We opened around 375, maybe just slightly higher, maybe closer to 4. Went up as high as about 570 and then closed the week right around $5. So, right, I mean, that's about a 20 to 25% move intra week with retaining about 25 per 20 retained was a retained 20% move, although the top on that week was about 25%. So not necessarily suggesting we get something that volatile this week, right? I mean, but something like a move up into 30. Well, I mean, sorry, excuse me, a move up to about 33, right? So, yeah, we're starting to get close there. The upper bound of our channels pushing 34. We do have some historic resistance at 34. Let me see where that goes back to. I have that marked on my chart as a historic level. Let's see. Yeah. Let's see, that 34 level, we did have a touch of it in June. We're going to need to go back, though. Several years, it looks like, right? Yeah, we had a touch of it in June. And then it looks like it goes back quite a bit. It goes back several years. Yeah, we had a high. Let me see. I'll share my screen here instead. Let me take a look. Right. So we also use historical support and resistance levels. It goes all the way back. That $34 level goes all the way back to 2021. So this was a support level. If we take a look here, right, that was our low in, what is this, like just before the June run in 2021. We used $34 about evenly. It was a touch of the the 20-week moving average. We used that as a historical support. And we also used it as a resistance point, right? That was our weekly high. The week after, let's see, this would have been what, the week of the most recent Roaring Kitty live stream, right? So sort of the week after that, I guess that would have been when Keith exercised his, or he didn't exercise his calls. He sold his calls and then bought shares. That was the high point on that particular week. So we've used it recently as an historical resistance point. We used it way back as a support point. So, I would expect, we have a chance, right? We have a chance to get in and use that. We have a chance to move to the upside here, certainly based on some of our longer time frames. Man, I can't get this to look how I want. Let's squish this maybe. Yeah, there we go. Right, so we can move up in here. We do have room to run, right? We've teased trading in this upper half of this channel, right? We've mostly been consolidating down in this lower half. We can move up into there. And when we take a look, for example, at our options data, it does look like traders are getting ready for something, getting ready to move us back into that area. So in terms of where our OI is concentrated, 30 has grown a lot. It's not quite like it was last week, right? It wasn't midweek. We were looking at something like 26 or 20,000, 27,000 contracts. End of the week, something like 20,000. 10,000 to start the week is more manageable. That's not quite as much of a threat to market maker profitability. I mean, if you're looking at 10,000 contracts going in the money, I mean, it's not optimal, but right, what they could do, right, is they could pump it into this area, right? They could let this run if they've held back some of that volume, right? If they didn't settle all of that bullish volume from Friday, they can let that out onto the tape today and sort of let this pump, say, into Christmas. There's some, there's the term Santa rally flying around sometimes. So, right, we do see that the way that the options market is betting, bullish bets they're all concentrated in this upper 30s range, right? Or this lower 30s range, between 30 and about 33. It runs out 33.5 to 34.5, and then you've got 35 kind of filling in as a potential future call wall. So we're trading right above this. If we hold this does look right. It looks like traders are aiming for us to trade in this area. And certainly if we look at that on a gamma exposure chart here, right, just not a lot of stuff below 30 right now. We do have a little bit of support. We have some weak support at 29 and 28. Right, we could go back there. With us trading above 30 right now, right? Trading in this little pocket does look to, this is our most stable trading range. It's where most of the options market is betting. It more or less tracks with the upper half of our bullish regression channel. And certainly from a dealer perspective, right, if they're seeing, right, they're running out of time, let's say, to reasonably aim for continued consecutive $30 closes or below $30 closes, there's only a few more weeks where that can happen without really significantly challenging our trading paradigm. And our recent pattern doesn't look like that's a weak paradigm, right? Bears have tried to eject us from this paradigm several times over the past couple of weeks, and every time it's happened, it's been pretty soundly rejected, right? An exit down, for example, down toward that 204-hour moving average, that move into say where these puts are concentrated, right down to 26.50. So that's not worked recently. We do have some lingering OI there, but it's not high conviction stuff, it looks like. Right? Already we're starting our week with max pain at 28. I mean, this is right. This is it. This is where the activity is concentrated. We've got some put OI in here. We've got some put gamma down in this range. Of course, if somebody comes out guns blazing and just tries to shove us down there, maybe we can do that. We don't have a ton of borrowable shares like we did back on Thanksgiving, right around Thanksgiving when we had that huge dump. There were over 2 million shares to borrow. The cost to borrow was essentially nothing. We're not even back to 1 million, right? International brokers reporting something like 900,000 shares available. So it's not none, but this is looking more like a tactical amount, an amount of shares that's well spent on, say, nudging the price rather than straight up manipulating the price down. And as I've mentioned before, there's now this increased risk that you could get something like a post from Roaring Kitty that causes algorithms to go off that traps you in your short position, causes you to lose a lot of money. So there's that to worry about. Yeah, it does look like our most stable range of trading is going to be 30 to 32 this week, especially early. Right, this changes. It's hard to say like how exactly will this shape. It's going to change dynamically throughout the week. If I were a dealer and I wanted to try to angle for the most profitable close that I could, right, and I saw, okay, I've only got 2 weeks basically where it makes sense for me to easily kind of get this, not easily, but without excessive manipulation, keep the price at the end of the week below $30, I would want to move, basically use IV, use a sharp move, let a sharp move kind of happen, let the options market come in, buy a bunch of calls, shoot the price maybe up to $33, right? Early and quick. The quicker it happens, the quicker you can jack up IV, and the more expensive you can make calls, which means the more premium you can rake in on call sales, right? And then you let it die out toward the end of the week. But what you do then is you attract buyers for later expiries, too, at higher and higher strikes that are paying these elevated premiums because of elevated IV levels. So that can make it, you can set up for a transition where you can say transition this call wall, sort of this strike management point where you've got a lot of accumulated OI that's soaking up. It's a big psychological number. It's soaking up kind of these gamble buys, just giving you free money as a dealer. You can make a transition out of relying on that 30 position to do that for you, and maybe transition to 235 and use that similarly. And then you've got, say, like another month barring bullish externalities or something to utilize that. And then if momentum dies out as a dealer, you're thinking, okay, then we just go back to using 30 later on, right? Something like that. Oops. So yeah, I mean, I'm not seeing evidently, right? I'm not seeing obviously anything right now that looks to me like we're in, imminent major downside retrace. I mean, yes, I'm keeping in mind what's going on with the wider market. I am keeping in mind that potential volatility, but not seeing critical risk here in GameStop. There's always potential tricks. Obviously, there are things that, right, I'm not perfect. I'm not an expert. I don't, right. There are things likely that I'm not accounting for, but based on the signals, based on the data, based on the structures that I look at on a regular basis, I'm not seeing any major risks. I'm not seeing any major red flags. And it does look to me like our path of least resistance right now is going to be trading in that sort of 30 to 32 range. Maybe we get something like a test of 33 midweek. But at the same time, I'm also keeping in mind that a finish sub 30, a close sub 30 is a distinct possibility this week, right? This is, 29.92 that's a really cool close last week. We're currently above 30 heading into begin the week in pre-market trading. But with that being said, never say never with these guys, especially while we still have some upper 28, 29 values that fit within our macro bullish paradigm. I wouldn't be surprised if we saw dealers try to make the most of those opportunities to push 30s once again out of the money. So I'm staying wary. I'm staying mindful of this. And but with that being said, I'm certainly spirited and enthusiastic about some of these some of the signs we're seeing on longer time frames for GameStop. So yeah, that's it for today. Thanks very much. Please go ahead and leave a comment. You have questions, if you have feedback, something you'd like to see more of, something you'd like to hear me go into in greater detail, please let me know. And yeah, thank you very much, everyone, for watching and listening. We'll see you next time. Take care.